There's a specific kind of investor that Western financial culture celebrates: the aggressive investor, the one who's constantly researching, the one who's hunting for the next big opportunity, the one who's checking their portfolio daily, adjusting positions, trying to beat the market, active, engaged, always optimizing. And then there's the Japanese investor. Boring, predictable, almost passive. They invest the same amount every single month into the same basic funds. They don't chase hot stocks. They don't try to time the market. They don't panic during crashes. They don't celebrate during bull runs. They just show up, month after month, year after year, decade after decade. And here's what nobody talks about. Over the long term, the boring Japanese investor consistently outperforms the aggressive Western investor. Not because they're smarter, not because they work harder at it, but because they understand something fundamental about investing that Western culture completely misses. If you've been told that successful investing requires constant attention, aggressive research, and high risk tolerance, what you're about to learn will change everything. Because the Japanese approach to investing proves that the best investment strategy isn't the most exciting one, it's the most sustainable one. Let's discover together why Japanese people invest so differently and why it actually works better than everything you've been taught. Western investing culture is built on a few core beliefs. Markets can be timed. Individual stocks can be picked for outsized returns. Active management beats passive indexing. More attention creates better results. And if you're not constantly optimizing, you're leaving money on the table. This creates a specific kind of investor behavior. You spend hours researching companies. You read financial news religiously. You check your portfolio multiple times per day. You feel euphoric when it's up and panicked when it's down. You make decisions based on those emotions disguised as strategy. And over time, all of that activity actually reduces your returns instead of improving them. Japanese investing philosophy rejects every single one of those beliefs. Markets cannot be reliably timed. Individual stock picking rarely beats diversified indexing. Active management usually underperforms after fees. Attention doesn't improve returns, and optimization is often just expensive distraction. So what do they do instead? The first principle: invest the same amount every month regardless of market conditions. This is called dollar cost averaging, and it's the foundation of Japanese investing. You decide on an amount you can sustain. Maybe it's $500 a month, maybe it's $1,000, maybe it's $300. The exact number doesn't matter as much as the consistency. You invest that amount on the same day every single month. Market up, you invest. Market down, you invest. Market sideways, you invest. News says recession is coming, you invest. News says the market is overheated, you invest. The decision was made once. Now it just executes automatically. This approach seems too simple, almost naive. Surely you should invest more when the market is low and less when it's high. Surely you should adjust based on conditions. That's what smart investors do, right? Wrong. Because here's what happens when you try to be smart about timing. You wait for the perfect moment. The market keeps going up, so you wait for a pullback. It pulls back, and you wait to see if it falls further. It starts recovering, and you wait to make sure it's real. A year passes, and you still haven't invested because you were waiting for the perfect time. The Japanese investor invested every single month during that year. They bought when prices were high. They bought when prices were low. They bought during the waiting period when you were paralyzed by analysis. And their average cost per share ended up better than yours, even though you were trying to be strategic. Think about your own investing behavior over the last few years. Did you invest consistently, or did you wait for the right moment? And if you waited, did that moment ever arrive? The power of dollar cost averaging isn't that it times the market perfectly. It's that it removes timing from the equation entirely. You automatically buy more shares when prices are low and fewer shares when prices are high. Math takes care of optimization while you just show up consistently. The second principle: invest only in diversified index funds, never individual stocks. This is where Japanese investing philosophy diverges most dramatically from Western investment culture. Western investors love picking stocks, finding the next Amazon, beating the market by identifying winners early. It's exciting, it's engaging, it feels like you're actually doing something. Japanese investors reject this entirely. They invest in broad market index funds, funds that own hundreds or thousands of companies, funds that track entire markets instead of trying to beat them. And they do this not because they're lazy or uninformed, because they understand that stock picking rarely works over long time horizons. The data on this is overwhelming. Over any 10-year period, roughly 80 to 90% of actively managed funds that try to pick winning stocks fail to beat a simple index fund. Professional investors with teams of analysts and sophisticated models can't consistently beat the market. Why would an individual investor think they can? But individual stock picking feels smarter. It feels like you're taking control. It feels like success is about skill rather than just time and patience. And that feeling is exactly what destroys returns. You pick a stock, it goes down. You panic and sell at a loss. You pick another stock. It goes up initially, then crashes. You hold it too long, hoping to recover. You pick another stock based on a tip from a friend. It does nothing. And over 10 years of this activity, you've massively underperformed an investor who just bought an index fund and ignored it. Japanese investors avoid this entire trap. They buy total market index funds, or broad sector funds. They own pieces of hundreds of companies. They don't need to be right about which specific company wins. They just need the overall market to grow over time. And historically, it always has. Think about your own portfolio. How much of it is in individual stock picks? And how have those picks performed compared to if you just bought an index fund? The third principle: ignore short-term volatility completely. Western investors are obsessed with short-term performance. How did my portfolio do today? This week? This month? This quarter? They check constantly. They react to movements. They make decisions based on recent performance. Japanese investors have a completely different time horizon. They think in decades, not quarters. They invest for 30 years from now, not 30 days from now. And at that timescale, short-term volatility is completely irrelevant. The market drops 20% in a month, the Western investor panics, checks their portfolio daily, considers selling to avoid further losses, loses sleep. The Japanese investor doesn't even notice. Or, if they notice, they shrug. It's just noise. In 30 years, this drop will be invisible on the chart. This long time horizon creates completely different behavior during market crashes. Western investors sell at the bottom because they're terrified. Japanese investors keep buying through the bottom because their monthly investment executes automatically regardless of conditions. They're not trying to catch falling knives. They're just showing up consistently like they always do. And here's what happens. The market recovers. It always does. The Western investor who sold at the bottom missed the recovery. The Japanese investor who kept buying owns more shares at lower average cost and captures the full recovery. Over a lifetime of investing, this difference compounds into massive performance gaps. Not because the Japanese investor is smarter, because they're not reacting. They're just consistent. Think about the last major market crash. What did you do? Did you sell in panic? Did you stop contributing? Or did you keep investing through it? The fourth principle: minimize fees and taxes through simple, low-cost strategies. Western investing often involves active trading, buying and selling frequently, trying to capture short-term gains, using complex strategies with multiple funds and frequent rebalancing. All of this generates fees and taxes. Every time you trade, you pay fees. Every time you sell at a gain, you owe taxes. Every actively managed fund you own charges management fees. And all of these costs eat into your returns, often by more than people realize. A fund that charges 1.5% in annual fees doesn't sound like much, but over 30 years, that fee compounds into hundreds of thousands of dollars in lost growth. The difference between a fund that charges 0.1% and one that charges 1.5% is retirement changing over long time horizons. Japanese investors minimize all of these costs. They buy low-cost index funds. They hold them forever, so they never pay capital gains taxes until retirement. They don't trade frequently, so they don't pay transaction fees. And they keep their investing strategy simple, so they're not paying for complex products that usually underperform simple ones anyway. This obsession with low costs might seem like penny pinching, but it's actually one of the highest return activities in investing. Reducing fees by 1% is equivalent to increasing returns by 1%. Except it's guaranteed. You can't guarantee market returns, but you can guarantee lower fees. Think about your own investment costs. What are you paying in management fees? How often are you generating taxable events through trading? And what would happen to your long-term wealth if you cut those costs in half? But if those four principles changed how you think about investing, the fifth one is what makes the whole system work. The fifth principle: separate investing from speculation completely. Western culture blurs the line between investing and speculation. Buying crypto hoping it moons? That's investing. Day trading stocks? That's investing. Buying options? That's investing. Putting money in a meme stock because Reddit said to? That's investing. Japanese culture draws a hard line. Investing is putting money into diversified index funds for decades. Everything else is speculation. And speculation is fine if you treat it like gambling with money you can afford to lose. But it's not investing. It's not building wealth. It's entertainment. This distinction protects Japanese investors from the massive wealth destruction that speculation creates. They don't get caught up in crypto bubbles. They don't chase meme stocks. They don't day trade. Not because they're not aware of these opportunities, because they've correctly identified them as speculation, not investing. And here's the key: they don't mix the two. Their serious wealth-building money goes into boring index funds. If they want to speculate, they set aside a small amount of gambling money and they treat it like the casino. They might win, they'll probably lose, but it doesn't affect their actual financial future. Western investors often bet their retirement on speculation. They pull money out of their index funds to chase the hot new thing. They convince themselves that this time is different, that they can get rich quick if they just time it right. And they destroy decades of patient wealth building in months of speculation. Think about your own relationship with speculation. Have you ever pulled real investment money to chase something exciting? And how did that work out? The Japanese investing approach isn't exciting. It won't make you rich overnight. It won't give you something to brag about at parties. You won't have stories about the stock you picked that went up 10 times. You won't time a market crash perfectly and feel like a genius. But here's what you will have: wealth that builds steadily over decades, returns that compound consistently, a portfolio that grows while you sleep, financial security that arrives quietly but permanently, and peace of mind that comes from knowing you're not gambling with your future. Western investors optimize for excitement and the feeling of control. Japanese investors optimize for sustainability and actual results. Western investors want to beat the market. Japanese investors are happy to match it while everyone else underperforms trying to beat it. And the outcomes prove which approach works. Japanese households have higher savings rates, higher median net worth relative to income, more financial security in retirement. Not because they earn more or invest more aggressively, because they invest more sustainably. The system is simple. Invest the same amount every month. Use low-cost index funds. Ignore short-term volatility. Minimize fees and taxes. Separate investing from speculation. That's it. 5 principles. All of them boring, none of them exciting, and all of them proven to work over long time horizons. You can adopt this approach. You don't need to be Japanese. You don't need special knowledge. You just need to resist the cultural pressure to make investing complicated, to make it exciting, to make it something you actively manage and optimize constantly. Instead, you make it boring. You set it up once, you automate it, then you ignore it for decades while it does what compound growth does when you give it time and consistency. No drama, no stress, no constant checking. Just patient accumulation while you live your actual life. The Japanese prove this works, not in theory, in actual retirement accounts, in actual wealth transferred across generations, in actual financial security built on nothing but consistency, simplicity, and time. And here's the beautiful irony. The boring approach that requires the least attention creates the best results. The exciting approach that demands constant engagement usually creates the worst results. You win by doing less, not more. By being simpler, not more sophisticated. By being patient, not clever. If this resonated and you want to learn more about investing the Japanese way, the boring way, the way that actually builds lasting wealth, subscribe to this channel. We explore Japanese financial wisdom every week. Not the exciting strategies that promise quick returns, the sustainable practices that create real security over real time. You'll find more guidance like this waiting for you.